Namaskar viewers, hello and welcome to Sansad TV. I'm Teena Jha, you're watching Perspective. The Reserve Bank of India is open to cutting interest rates again this year. RBI Governor Sanjay Malhotra has signaled. With inflation cooling faster than expected and growth holding steady, the central bank is signalling that more policy easing could be on the cards. In a recent interview, the RBI governor sounded optimistic, projecting full-year inflation below 3.7%, the lowest in years, and also hinting that if the economic momentum holds, interest rates could come down further. So what does this mean for your money, for your loans, and the economy at large? We'll try and understand from two distinguished experts who are joining us on the program. It gives me immense pleasure to welcome on the show today Dr. Ashok K. Nag, former advisor, Reserve Bank of India, and Dr. Charan Singh, CEO, EGROW Foundation. Thank you to both my guests for joining me on the program today. Welcome to Sansad TV. Dr. Nag, let's begin the program with your thoughts with how you interpret the RBI governor's decision. So he's signaled at more rate cuts if inflation slows down. But the question here is, alongside easing inflation, hopes of easing inflation further this year, are there also several underlying factors which could be behind the RBI governor's statement?
This governor's statement is, of course, is optimistic about the progress of the status of the state of the economy in the future, next 1 year or something. Now, this is okay because you see that obviously inflation has come down substantially. But one should also understand that inflation coming down does not mean that price is coming down. What it does mean is that the price growth has come down. It is not growing, is it? Because if you look at this, some of the prices, like it is what's the consumption of the people, particularly food consumption of the vegetables or things like that. That price went up very high. Okay, a bottle goat in Bombay now cost you the 80 rupees per kg. Okay, which might be 1 year back 40, 30 rupees per kg. So it has come down. It is now coming down, substantially. So that is why obviously inflation is going to be coming down further and further, because it is not possible that price will go again down. Then also last 1 year also the inflation is coming down because certain kind of factors like internationally. For example, our oil, the trade deficit is coming down. Okay, the trade deficit coming down because one of the reasons is that we oil which is purchasing from Russia and selling it abroad, that is quite a good kind of a contribution to the trade deficit coming down. Mm-hmm. Now question is that this whatever has been told in the month of June and everything are going to change substantially in the month of July, because international environment, the entire equations between all the states are almost now is a different path. What is the problem is that, see, for examples, why this particular, whatever the governor is doing, taking these things, this is quite, may change substantially, because if these tariff kind of things which are happening, and whatever the tariff, if particularly to punish the Russian Federation, right, if they bring down tariff on this as an additional tariff here, then our export also will be affected. If export is affected, of course there will be kind of effect on some of the important kind of sectors like pharmaceuticals, other things, which we are very, very one of the topmost kind of a country as exporter of these generic pharmaceuticals. Now, how this is going to really roll out in next 6 months or 7 months is something very, very important for us. Absolutely. To know. Yeah, and if you look at this tariff war, which has been started by the US, it is a reminiscent of what has happened. There is called Scoot-Hawley, a kind of a act was passed in 1930. Okay, I think, and it actually led similar kind of a tariff. I think 2,000 commodities tariff was increased substantially by the USA. And that was one of the very important part of the World Depression, and then afterwards World War thing. Now, this kind of things, if the entire international trade, because today supply chain management is a very, very international. Okay, not anything is produced by any particular country. Now, if this kind of tariff things happen, how is going to affect our economy? It is too early to say that how it will happen. What kind of a tariff will be imposed on us? Which are the products will be affected? For example, agriculture. Agriculture is a very, very key things. We don't have any kind of a competition from outside on our agricultural products.
Right.
Okay. And agricultural products are the bigger price, and that is quite. Today the price is quite manageable, and that is what inflation of things are quite good. And vegetables or things are small amount, but it is generally. Now, if we have this kind of a tariffs, or it forced us to reduce tariff for the export from the USA, then it will have a tremendous effect on our production of agricultural goods, particularly in the day. How it is going to happen, how it is going to be figured, which is difficult to know.
Certainly, sure. We'll talk about all of this as well, about how the geopolitical tensions are also panning out, how the tariff war is panning out in due course of the program. But Professor Singh, Dr. Nag has spoken about various aspects which include the rising exports, India's rising exports, despite the geopolitical tensions, but the trade deficit having narrowed down also significantly. But the question here is, let me first get your perspective on the most recent statement in the wake of these factors that comes in from the RBI governor, on which we based our program today. If the growth momentum continues, there could be more rate cuts. That's the statement from the RBI governor in one of the recent interviews. If this happens, this could be the third rate cut. So the question and what we want to understand from you is, how effective have the previous rate cuts been on this growth momentum? And if there's a third one, what does it mean for the people and the economy?
First of all, I would like to say Governor is absolutely on the track when he says that the rate cuts are very essential in a country like ours. If we are aiming to be Viksit Bharat, which means in 22 years, which means our per capita income, which is 2,880 today, should rise to around 17,000 by 2047, we have to record a good growth rate. 6.5% is the highest anybody would have attained in the current context, but then we want to attain we are chasing a beautiful dream. We have the capacity. We have the demographic dividend with us, which nobody else has. And if we do not avail this demographic dividend right now, then of course we will miss the bus very badly. Of course, it's a challenge, but the governor seems to be accepting the challenge. The global experience, Korea from 62 to 89 grew at 8%, and there were many global challenges at that time. China grew at 9.9% from 1980 to 2012. There were many global challenges at that time. Right. The governor is attempting, keeping in mind the Prime Minister's dream of Viksit Bharat, and we all aspire to be there, the young demographic India. He's creating a very conducive environment in the country, saying that the interest rate will not come in between. Otherwise, there'll be a sacrifice ratio. If the interest rate goes up, you know that investment will not take place. And if investment doesn't take place, growth cannot take place. Now, please remember, some economists like me have been arguing for a very long time that the interest rates that were raised in our own country, consequent to the Russia-Ukraine war, where inflation had increased 5 times more than their 30-year average, unlike India, where inflation was always under control, that rise should not have taken place that rapidly. Nevertheless, it happened, and there were arguments on the other side that capital flows have to be taken care. That's okay. Now that the economy, global economy, is passing through an uncertain phase, as Dr. Nag has tried to elaborate, and there is uncertainty, but within the country, we are growing at a very good rate, the fastest in the world. And we have to grab this opportunity and not let it go. Now, in any central bank's mind, there'll be two things: price, inflation and growth. Now that inflation seems to be under control, and as you already know, that the Reserve Bank itself had projected inflation of 3.7% for the year running and 2.9% for the first quarter. We are averaging less than that. 3.7 for the whole year is less than the 4% pivot that inflation targeting regime has. Many of us feel that that's also a little low, but nevertheless the inflation that we are achieving now is lower than that.
Yes.
As far as growth rate is concerned, the projections are at 6.5%, and we all know we have a potential of growing faster than that. And therefore, I think the governor saying that inflation is under control, I need to now take into account the growth factor and allow a conducive environment in the country so that the growth can take place. One more point which I want to make is, where was the inflation coming from? Mainly supply side factors, but in our country, vegetables, and now if you look, vegetables and primary articles are the ones where there's negative inflation. So therefore things are under control, something which impacts each one of us, food, things are under control. Oil prices, as Dr. Nag has already mentioned, thanks to Russia, we have been able to get, and there is if you look at the wholesale price index, the prices of fuel are in the negative zone. I think that's also a very positive sign. So I think the governor is very much growth oriented and very much correct in saying that in a young demographic India, under the Viksit Bharat Amrit Kal, he is providing a good opportunity for growth to take place.
Professor, two more things that we would like you to explain to us and our viewers. What do the potential short-term and long-term rate cuts, what kind of impact do they have on inflation and growth? And how much of it is also impacted by, the global rate trends? So something that is happening perhaps at the US Fed or the ECB. How do they impact RBI's decisions domestically? Professor.
Is that
yes.
Myself, Doctor. You're talking to me? No? Yeah.
Yes, Dr. Nag, you can take
Yeah. See, RBI has its own instruments. One of the major instruments which are likely to affect the economic progress or economic growth is the inflation. High inflation is not a good thing for both. So RBI is definitely taking the proper kind of stand, as Rahul has said, that it is possible now and they have accepted, and I believe that they will continue to do the same on the path by decreasing the interest rate further. But this is one aspect of the growth momentum, that inflation is low, rate of interest is very low. Now question is that you have to invest. Ultimately, your higher growth coming to only because you have to have an increase. Now, if you look at this, what is happening today, the growth is now the investment which is happening mostly in the public sector and some in the private sector, not with the large corporates. That unless they take up the growth of the investment, more of investment, then only our system will growth of the 6.9 Viksit Bharat. If we want to do that thing, we must go beyond 7%. We must go reach the price stable like 9%, at least 8 to 9% growth rate to achieve that. That will happen only when investment are made. Now, if you look at it today, what has happened that one of the growth, some of the growths are happening. For example, I'll give example of the Mumbai. Mumbai, if you look at it, now there is a huge kind of developments are happening on real estate. And the prices are very high. But why it is happening? Because there is a demand is coming from our abroad NRIs. Today, a large number of NRIs in the USA are afraid of that what is there in future as a NRIs. Whether the children will be able to get a citizenship of it. So they are, because today in Bombay, even 700 square feet flat, you will get you 2 crores rupees. which is not it. But these are the things are coming. That is a positive kind of a impact on India's economy that we are having those kind of things. But what is more important that our corporate sector and the manufacturing sector, that has to increase, and our savings of the household sector savings is not increasing for.
Okay, we seem to have lost connection with Dr. Nag, but we'll try and get back to him in just a while and reconnect with him. Professor Singh, I'll get back to you, and in context of what Professor Nag was saying, I'll try and understand from you about the challenges perhaps that the RBI also faces given the global volatility, but given the domestic scenario. So in this global and domestic context, does RBI face the challenge of trying to strike a balance between domestic inflation targeting and at the same time also maintaining the need to stay globally competitive when it comes especially in terms of this interest rates? Sorry, Dr. Nag, we lost your audio, so I threw that question to Professor Singh. I'll come back to you.
So I would agree that there are global pressures. Now, please remember in May 22, the repo rate was around 4.4% or something like that. And I think that was a very good rate that was conducive for growth and investment. Now, when you have raised the repo rate very high, and everybody knows it has been raised because of global reasons, and it is about to come down, should come down sooner or later, investment would not happen because investment will wait for the rate to come down. And that is the key reason why you find that the private sector investment was not taking place in the country. We had achieved an investment rate of about 39%. We are down to about 30%. Most of the investment that has been coming from the public sector, the government through the fisc has been doing it. And most of it is in infrastructure. That is very good. It provides you a threshold. Private sector should now crowd in, and that will happen. But once the interest rate is brought to a level where private sector feels that at this rate of interest they can invest and their investment will be commercially viable, you will find the private sector having now the advantage of infrastructure coming in a big way. The RBI has also to weigh in the global interest rate cycle. As you know, the USA had suffered from a massive inflation, again thanks to the Russia-Ukraine war. So did Europe. Given that they were facing a 5 times higher end, so did England, 5 times more inflation than their 30-year average, their policy rates had also increased tremendously. Keeping in mind the capital flows, the Reserve Bank of India, and keeping in mind the exchange rate, the Reserve Bank of India has to factor those things. And therefore, there is a sort of trade-off that they need to balance between the international environment, the international interest rates, and our interest rates. So that part is clearly understood. But now, when the downward cycle has started in those countries, India should match it, or rather do it, unwind it at a faster pace. And I'm very happy that the Reserve Bank did that in the last cycle. And I'm sure, given that the governor's statement that I saw looks to be very positive in that direction. Also, one point, that last point I want to make is, yes, there is a tariff war, we all understand that, but then there is also tremendous pressure in the US that they have to correct their interest rate cycle too. And my reading is that correction will take place sooner than later. Having said that, then India should not lose even a day in making the correct interest rate decisions and bring it at a rate at which the private sector finds it conducive. And once it finds it conducive, the interest rates are low. As you remember, the governor mentioned that the transmission that happened so rapidly, 24 basis point, already at the new loans and 16 basis on the overall outstanding loan. So the country, the banks, the institutions and the people were waiting for this correction. And the investment generally kicks off a few months after the interest rate is corrected, because you have to go back to the drawing boards, you have to start planning and start procuring land and then ordering for plants and machinery. It takes 6 to 9 months before it translates onto the ground. And that is exactly what I foresee.
Dr. Nag, so in the wake of these external pressures which continue to impact the decisions that the RBI also makes, how should India prepare for a possible, say, global stagflation or rate hikes that happen in the West, while at the same time maintaining this growth momentum that we are seeing currently?
Yeah, see, what is important for India to do, and RBI is obviously taking the steps which is RBI can take, positive kind of steps to help this thing. But what is happening that what is important for us to improve areas which I think the government has to look into this. One, the private the household, the debt and the savings, whether we can correct it to a greater extent, okay? Second is that why the corporates, the investment has to be built up. And for that, see, important point is, see, interest cost is not necessarily the maximum proportion of the cost of the your corporate any investment. Okay, it is the most important that availability of the fund they will get and how much they can get it from the market or how much they can get it from the banks. Now, banks, what do we see that the deposits of the banks from the what we call the individuals and the non-corporate sector is not increasing fast. Okay, the availability of the fund is important. Interest rate is the cost of the fund. But if you don't have the proper availability of the funds, which is more important, and government has to take action from there. How is, for example, how much is the fund, money government can do by tax, restructuring the taxation like GST, other things, whether people can get more money in their hand and they can spend, and that will increase the, progress of the manufacturing sector, so that they can produce more, and they will start investing. See, this is the kind of the point is there where I have to see that people have more money in their hand, those who are not corporate, but those who are the general public. Right. If they have a fund in their things, they will obviously consume, they will have an investment, and that will increase the, your market for the corporate sector, and that will actually go the progress. So I think there are multiple kinds of things out there. Economics, so everything is not so free. Everything you have to know that where it is actually pinpoint the main hurdles, because they're all interrelated. Okay, it is a duty of the RBI as well as the Finance Ministry together to decide that how we can address these issues and bring about the progress. We have the potential. India has a huge potential for growth, but we must grow not by 6%. We have to grow by 8.9% so that we can give my 47 becoming a Dikshit. Dikshit Bharat is not for the only total, but also the people at large having a Dikshit Bharat kind of a experience.
Certainly, and towards that vision, Professor Singh, we've seen several policies aimed at inclusive, sustainable growth. But looking ahead, if you have to assess the Indian economy's growth and the health of the Indian economy, what would be the 2-3 critical sectors or indicators that you will be watching out for in the next 6 to 12 months to perhaps have that kind of assessment to see where we are headed at and whether we are able to realize the vision of the growth that's been forecast for this particular year, but that also takes us closer to our long-term vision?
Absolutely, absolutely. I would like to mention the most important thing is that when we are heading towards Viksit Bharat, I think the Prime Minister's clarion call that he made at Niti Aayog about a month back, he said that the states have to join him in this endeavor. And the states, once they come together and they start growing and they start aiming at a growth which brings the per capita income, as I mentioned, from 2,880 to 17,000, they start planning in that sort of a horizon, then you find that India will be able to attain its growth. To maintain that growth level for the states, the financial institutions will also have to play a role. The financial institutions now are financing an economy which is in the range of about 3.4, $3.5 trillion. And we would by that time be aiming in the range of 37 to 40 trillion dollars. Because we are competing with countries like China, America, and certainly we'll be the third largest by that time. We have already overtaken Japan and we'll soon be overtaking others. We have to remember one thing which is very, very critical. The per capita income of the US is 82,000 now, and of China is around 13,000 now. So we have to keep pace with that. Now, which are the sectors which will play an important role? Infrastructure certainly will have to play an important role. Manufacturing will have to play a very important role. We have a winning edge in IT related. And I think that is where we will have to play a role. AI, machine learning are coming up in a very big way. We'll have to maintain the lead there. Very, very important. COVID has brought us, and it's a great advantage in terms of pharma. And I think that is where we need to maintain our lead. And in that pharma, I think we are doing something extraordinary. Rather than only going for treatment, we are saying we need to look at the wellness. And I think therein our Ayurvedic products can help us. Given the large size of the country and the demographic dividend, if we are able to ensure production of Ayurvedic products, we'll find richness spread across the country. And the last point, India now is becoming a very important destination across the world. Our status, our democratic values, and the maturity that we have shown during COVID and after, becoming a great destination. And therefore, I think tourism of all types, religious tourism, medical tourism, natural tourism, village tourism, I think that needs to now become important, and that is where. And what we have seen at the Mahakumbh, how it changes the economy. The Ram Temple has already given a difference to us. So I think we need to focus on tourism, and that will be a very big advantage in the initial stages to take off.
Okay, taking on from what Professor Singh said, Dr. Nag, one concluding comment from you. By far, right since the COVID happened to the global headwinds in the form of the Russia-Ukraine war, then the tensions in the Middle East, the Indian economy has been resilient to all of these external pressures. But while the global capital flows are also at the same time shifting rapidly, what is it that we must prioritize to maintain India's attractiveness as an important investment destination, alongside developing India as a country suited for medical tourism and for other scenic beauties? It's important to be a country that attracts investment, in large amounts.
See, what India is a very large country, although per capita income is not so high. Being a large country, we are becoming a $1 trillion, I think, income. Okay. Now, what is important for us to understand that the world is changing fast in terms of technology. Okay. And for example, let us look at IT. We were one of the largest IT manpower provider in the world. Okay. And that was very good for us. Our IT companies really progressed and become very large, like TCS, other things. But what is lacking in India is that investment in technology, progress in technology, to do a kind of a state-of-the-art research. And for example, farmers, we are very good destination for people come from, at least from the Middle East or something, for any kind of a medical treatment to India. So this is a big kind of a source of our income for them. But tomorrow, suppose we have already seen today, that is what you call robotic kind of a surgery, robotic kind of treatment. We must take up this challenge. We must take up the challenge in every field and have your own kind of a capability to create products of the highest quality. By becoming only the number of people more and giving only manpower, and that can work up to a certain extent. But if you do not have a proper technology where it compete with China particularly, then we will not be able to, after 20 years, even stand in the queue, because number is more, but we don't have the resources or technology to fight, or not fight, but to compete with them. We must have the technology, and
Absolutely.
that technology has to be taken care of, and government must have a proper kind of a effort to incentivize the technological kind of investment. How many of the AI which has been created by the LLM model, all are done by the Indian experts, most of them. But where? Abroad, not in India. This has to be changed. We have the manpower, we have the best people who can do the things, but you have to create a kind of environment of the innovation, environment of investing in technology, that will be real kind of Viksit Bharat will become interesting. Otherwise, we will definitely become a third or fourth level.
I think that's a wonderful suggestion, engaging the best Indian minds in developing India, shifting us or taking us closer to our vision of a Viksit Bharat. That's what the Prime Minister means when he says everyone, 140 crore Indians, but at the same time, Indians living abroad have to think of this vision as their own, and only then collectively can we realize this vision. With that, we'll have to wrap up the conversation, gentlemen. Thank you once again for joining us on the program, sharing your thoughts with us and our viewers. Time allows us to take up only that much on this edition of Perspective, viewers. Thank you very much for your time as well.